Hi guys, welcome to Savvy Money Show. Me, your host Sean. Well, we have a lot to get into, so let's jump in. IQST receives formal offer for EV subsidiary from pre-IPO company, and apparently it's a big one. In case you're wondering why it jumped up, it's apparently for more than the company's worth. But sorry about that. In case you're wondering why the company's gone up over 20% in the space of a couple of days. Now we're heading on to the next company, GlaxoSmithKline. Now, is it been going up because it's got the FDA nod for MMR vaccine? No. Is it because it gives a 4.5% dividend? No, that's already passed. Or because it has a PE of 17, or forward PE of 14, or market cap looks undervalued compared to DV. No. The reason is it took over a company, and it's a small subsidiary, but it has a small drug trial going on in 18 rectal cancer patients, and the cancer vanished from every one of the patients. Now, of course, there are a number of trials to go so far, but this is the first time this has happened, and where everyone in the trial has ended up in remission. So, of course, this has risen Glaxo, and if it goes all the way through, I can expect it to do extremely well. Don't forget to hit the lovely like button and sexy subscribe button, and don't forget the bell notification. You'll be notified when a new video gets uploaded. And the free links in the description below. You can pick up a free share worth up to £200. And check out our Discord. And if you want a more in-depth analysis of any stock or market conditions, then why not look at our upgraded membership program and support us. Ray Dalio says the Fed won't do a U-turn for 2 years, so it's no coincidence that then Elon comes out and says Starlink won't IPO until 2025, and it's not a play he's doing. He just doesn't want to IPO in a bear market. He wants to IPO in a bull market, and you'll see that IPOF has gone down the past couple of days, and that's why I always say to people, when these rumours come out, you should always trim some of your position. I took out my initial investment during the rumours run up. When it comes back down, I put my investment back in. Each time the rumours come out again, I take them out. Now I was holding 3 shares risk free. Chinese stocks are up on China giving the okay for gaming stocks, and there's been over 60 apps since the end of April. Then we've had likes of Barber going on a huge run. Now was incredibly oversold, and now I don't expect this to continue, as you'll see people taking profits. And I think today you'll see that the US market is up on short covering. The Fed is talking about looking into payment for order flow. That is why you've seen the likes of AMC and all the others going up. Credit Suisse reports the third profit warning. The saying that not as many people are saving with them, and I'm sure you probably get that with other banks. Margin debt is declining. Mortgage applications are down 6.6%. Now, we're going to look into monthly dividend portfolio to protect your account. And the reason for this is we like to get paid during the downturn. I'm not just going for monthly dividends, I'm going for monthly dividends where they're going to, the stock price is going to improve as well. Let's start with PSEC, 9.6% dividend, which is a BDC which make loans to small and medium-sized companies and take a small equity. They get similar tax relief to a REIT, but BDCs are effectively a bank. So you want one that's invested in multiple sectors, not just one or two sectors, because if that sector gets hit during a recession or downturn in the market, the BDC will be hit. CRT, Cross Timbers Royalty Trust, despite the name, it's nothing to do with timber. It's an oil and gas royalty play. So they have the land, they lease it out, and they get paid royalties by the oil and gas companies, and they pay a 6.86% dividend and have a PE ratio of 17. Now, PFLT, you may recognise some of these from ones I've spoken about before, like Pennant Park and PSEC. There'll be others you'll recognise, but don't let that put you off. It's 10% floating rate loans expert. Now that should do well with a rate rise, and with these companies, just in case you're looking for ones yourself, I look for ones with solid cash flow, have a good dividend history. I then look to see whether they're a small cap or large cap, because if they're a large cap, I'm more comfortable in picking them up. Those who have been with me since the start will know I do one of these every year, and you'll also recognise the next two ones, because although the dividend isn't as high as the others, the yield usually is, and they've come back down to a similar price it was 2 years ago. Now it's a 4.5% dividend, and it may seem low, but it returns an additional 4.8% when you consider it's a downturn market as well. Now 43% of Stag's warehouses are in e-commerce, which usually mean long-term and growth. Land is 2.13%, dividend 16% yield in a downturn. Farmland, and we know they're in favour. I said that to you last year, and with the food shortages, the farmers are making money. What are they spending it on? They're spending it on equipment, spending it on more land. Those you're getting, those that can't afford it or out of work are looking into getting into farming by leasing land from the likes of Gladstone. The next one is a 16% dividend, but the reason I watch out for it is because it's a risk right now. It's a REIT. You have, which means they borrow money at low rates, and then they use it to buy up property and rent them out. Now, the problem with this model, even though they get better rates, they get lower taxes because they return a higher percentage to shareholders. The problem with this model is if we do get a downturn in the real estate market as expected, REITs are going to be the first ones to get hit. You will also have them with a rate rise. They will get hit. So this might be one that you keep on your watch list and pick up later in the year when it's depressed, and then you will know if they keep the yield or if the yield will actually be higher, depending on how strong the business is. But you can see it has a forward PE of 7 and a price to book of 0.74, which is good for. Now in the UK, they're announcing housing reforms, so this is try and stave off a housing crash. They may do the same in the US. We never know whether there's going to be a crash or not, or whether they're going to do something to stave off. Now, ETP is energy transfer. I did a breakdown of this a few weeks ago. Discounted cash flow, its valuation should be over $14, and it's stayed between $10 to $12 range. Whenever it's hit $12.50, I've sold, although I think I'll keep it at the moment. I've put all my oil stocks into energy transfer when it's hit the $10 range, and I get a monthly dividend which is 6.75%. I like the fact that they've transferred from just a midstream play. They took over a producer last year, which was a great piece of business for them. It was incredibly undervalued. It was around about November. So they get all the assets, and what timing. They got all the money on the books. I just think this is a good one to hold. You can see how undervalued it is. Market cap to enterprise value, forward PE of 7, price to sales 0.44, price to book of 1.07, and they deal with the pipelines, they deal with the producing, and they do some refining, but not as much. So they are getting their fingers in each of the pies. I do think it's one you need to look at and have on your books. Of course, when oil does end up giving up its gains, I do still think this will be one to hold, just not as much. Make sure you've taken your initial investment out by then. It will still be paying a certain amount of money. I see this as a hedge. When all these big oil companies start going downhill, and these speculative ones, this one will be okay. So my oil plays are going to be this and IMPP and ZIM. IMPP and ZIM are oil tanker stocks, so they're not in the same bracket, but it's still the ones to hold. The problem with ZIM is it's not a monthly dividend stock, but look at the dividend, and IMPP doesn't at the moment pay a dividend. Otherwise they would be in this list. ZIM, using discounted cash flow, is half the value it should be. Anyway, that's all from me. Don't forget to hit that like button, comment in the box below, and subscribe. Check out The link's in the description. Get free stock, free cash in your account, and links to the Discord. I'll see you later. If you found any of my videos helpful and you want to help me make more, you can support me by buying me a coffee. The link is in the description below.